The focus of this reading is the basic return concept. There are many different terminology about return, sometimes pretty confusing. So this reading is trying to clarify that. Now, let's look at that different type of the return concept here. And then we analyze that and how do we use this and how apply that to the analytical problem. Now, first, talk about holding period return. That is most of the time we talk about percentage return concept. The holding period return, of course, you are holding an investment for one period or per multiple period of time. Here we're assuming this one period of time. So if you purchase an asset, say suppose you purchase stock is $100 and holding for 1 year. So in 1 year, what do you expect to get after 1 year? First, you're going to get dividend. Or if you put in the stocks, you get a dividend. You put into the fixed income security, you're going to get interest. So there is some kind of we called income source of cash flow. All right, so it's a cash flow, dividends or interest. Also, holding for 1 year, by the end of the first year, you're going to sell it. Suppose you're holding 1 year, you're going to sell it. Then you're going to facing the selling price. So you're going to face either some capital appreciation or called gains, or you may have some loss. So we call capital loss. Therefore, the return had a two component. One is a cash flow yield. Yield, Y-I-E-L-D, meaning it's a return. But pretty much the yield refer to fixed income return. All right. And that tried to differentiate with the growth or the gain from growth. So we focus on yield from income and the gain from growth. So there's a growth or loss, or could be positive growth or negative growth. If the price had a positive growth or appreciation, then you're going to have the capital gain. Otherwise, you will have a loss. So we got a income, yield, and gain and loss involved with your return. And this we call holding period return. It could be 1 day, 1 week, 1 month, 1 year, 1 quarter, and so on. And then most of the time, our analytical report, we're going to use annualized return. So it is necessary that we will convert our holding period return to the annual return. So for example, suppose you calculate the weekly holding period return of 0.5%. That means every 1 week the investment is going to generate about 0.5% of return. Then the question is that this being the case, what is the annualized return? Most of the time that people will say, well, that just use the 0.5% times 52. Well, there's some approximation, but a more robust approach is the geometric approach, which means that we're thinking about a compounding, right, process. So for example, weekly return of 5.5%. If you keep the same return every week for the 52 weeks a year, right? 1 year you have 52 weeks. So the compounding of the 0.5% will be compound 52 times. So that's the reason we use 1.005 times the 52nd power of that. That is the geometric compounding result. But since remember, you have to plus 1 because you're looking the holding period. So you get $1 and you will generate 0.005 dollar, and then 52 times compounding. Of course, you have to minus 1. Then you're going to get 29.6% return, which means that every 0.5% weekly return is going to generate 29.6% in a year. The second concept of return is expected return. So, so what is expected return? Expected return by definition is a total gain and loss in terms of percentage of an investor anticipated on an investment. So it is anticipate rate of return. Anticipate mean you hope you will get. So there it goes involves some kind of probability. So statistically, the expected return is the probability weighted average return, all right, or I would say probability weighted average of future return. Now the future return here talking about total gain and loss, which means you have gain and loss, the return from income, and as well as from capital appreciation. So here say that multiplying potential outcomes by the chance of them occurring, then totaling these results, which that means is the weight probability weighted average. The chance means probability. For example, if an investment had a 50% of gain, all right, 50% chance of gaining, and 20 gaining 20% return, and a 50% of losing 10% return. So what is expected return? That is very easy. It's a 5% because it is the weighted average. 50% of 20% plus the 50% of negative 10% because of loss. So that is a 5%. So this we call the expected return. Just keep in your mind the expected return involving probability. The next one is the required rate of return or required return. That is slightly different from the expected return. And sometimes a lot of students confuse between the expected return and the required return. Required return meaning is required by somebody. So it's required by investor. It's not just expected by or anticipated by investor. It's required. So require means that it's a minimum level of the return or the expected return that investor is willing to accept. All right, they want to require in order to accept the investment or invest to an asset for a period of time and given the risk of the investment. Therefore, the required return, it is a risk-adjusted return. Okay, the expected return is a probability weighted anticipated return. The required return is risk-adjusted return by the investor or required by investor. Since this is the risk adjust, so it's in some sense is the same concept as opportunity cost. The opportunity cost for investing in an asset, all right, the highest level of expected return available elsewhere from investment of similar risk. So what does that mean here is this, all right? So you suppose you have $100,000, you can put in the bank to get a return, say only 1 or 2% a year. That's risk-free. Okay, so in order for you to put that $100,000 to some project, you want to do is to get some higher return than at least 2%, right? Because you want to get at least you want to, otherwise just put in the bank and you have no risk. So in order to accept appropriate risk, then I will have to have say 10% return. Otherwise I'm not going to do that. So that 10% is more like the opportunity cost. Okay, if I do that, what should we do? What happened with that? So it could lose that. So I will require at least 10% to compensate the loss. So that's the opportunity sense and the risk-adjusted return concept that we call required return. So mathematically or logically, the required return is the risk-free return plus a required risk premium. Just like previous example, compare the 10% versus 2%. The 8% difference is there. That is required premium to compensate the risk. So it's a risk premium. And the 2% is a risk-free rate. So investor will require 10% return. So this is important is it refer that the required return it vary by different project. We have learned that in the previous courses talking about capital budgeting. Say for example, we have project managements to select appropriate project and we calculate the value of the project. The value is the present value. Sometimes we call net present value. So the net present value to determine whether we're going to accept the project or reject the project, the discount rate to determine that value is the required return. Okay, it's some kind of required return because the project is investment. The project is investors required in order to accept. Therefore, any discount rate in the project management, it is a required return and it is a risk-adjusted return. And the risk-adjusted return is two-sided. All right, let's think about this. The required return by investor, it is the cost to the company because the company is borrower and the investor are lender. For example, bond holder, they are the lender. The shareholder provide capital to the firm. They are shareholder for equity. Regardless is from equity or from debt, they all are investor and they all have required return. And that return, it is the cost to the firm. So the required return to the common stock, it is the cost of equity, where the required return from the bondholder or the debt holder, it is the cost of debt. So that's pretty clear. The cost of capital, it is required rates of return. All right, it's just two sides. One is from the investor side, the other is from the company or the user side or the borrower side. So we want to make sure that we understand that the required rates of return concept.